Welcome to the Day 2 podcast. Today's episode, how to grow your business valuation for that ultimate wealth creation event, the sale of your company. With me today are the co-founders of GW Partners, Chris Shipferling and Jason Somerville. What Chris and Jason share today is what most brands learn the hard way after the fact. Chris and Jason, how the heck are you guys?
Good. Yeah.
Thanks for having us.
Are you guys both in Chicago?
Other CH, Charlotte.
Okay.
More south. Yes.
All right. Let's edit that out.
But yes.
So you guys are both in Charlotte?
Yes.
Okay,
yes, we
great.
are. Yep.
Okay,
Yeah.
excellent. What a
That's
fun
right.
town. Thank you for joining the Day 2 podcast today. You guys have a wealth of experience in the investment banking area, business brokerage area, and helping companies get maximum value at exit. So we've got a very captive audience for you guys today on YouTube and on our podcast. So my first question was going to be, is anyone buying product companies these days? But then a press release came out from my friends over at Unibrands that, they actually bought a company and they did another raise. But before that press release, guys, you're much more connected to this than I am. I've heard crickets. What are you seeing out there?
Yeah, I mean, we're definitely seeing some activity. I would say there's a couple sectors that I think are where most of the activity is happening right now. So food and beverage is one where I'd say so far this year, that's where I'd say of any sector in the product world, that's gotten the most activity, whether it's raising capital or mergers and acquisitions. So food and beverage right now being most active.
People got to eat no matter what.
That's the thing, man. It's funny, you would think as human beings, we've figured out every different way to, do food. And it seems like, nope, there's still plenty more ways to do food. The amount of, call it infused drinks that raise capital is amazing. Like whether I saw one this past week, it's a ketone. It was a ketone infused drink. So that's how to get your ketones without going into ketosis. And CBD infused drinks, and I'd say the alcohol space is pretty active these days. So food and bev, definitely one. I'd say number two right behind it would be beauty, health and beauty, definitely, where there's plenty of activity, a lot going on there for sure. I think, durables are definitely a little bit slower these days, kind of durable goods categories. Although, like a good example, like we've seen Yeti do a couple of acquisitions. Like they bought like a what was it? It was like a cookware company that was doing like cast iron.
Yeah, that's right.
And then a little bit in apparel, a little bit in goods.
Okay, so you guys are seeing some activity. Okay, just not activity like there was in 2021.
Yeah, I mean that we haven't seen activity like that since 2021. I mean,
okay.
So it's
Got it.
it's been down since. I mean, 23 was a slow year in M&A in general. Like, I mean, across the world, it was. If you look at all M&A, 23 was the lowest volume year in about 11 years.
You're very active in the Amazon space, Jason, and you probably even have heard some business brokers inside of the Amazon space, kind of Amazon-centric business brokers, still saying things are very active and et cetera, et cetera. We're not here to call anybody a liar. I will say there's probably slight exaggeration, but I will say this. If there's anything getting done, it's because seller expectations have gone down considerably.
Yeah, I mean, I think we're down. Like, I mean, if we're talking about, say, product businesses that are Amazon-centric, I think valuations are probably on average down 50%. From where they were in 21. So let's say they've been cut in half. The way we look at it though is like, so we were involved in e-commerce M&A before there were aggregators. So what really has happened is I think the market in many ways has returned to like where it was before. You had, all of that money get raised and then all of a sudden the valuations were bid up very considerably because of it. It's kind of returned to the pre-aggregator kind of world. There's definitely some differences, but in terms of valuations, it's like, okay, we're pretty much back to where we were before the aggregators.
And I don't think you really hear business brokers in the space screaming multiple. It's more about, can you actually just get it done? That's really what it's all about now.
Can you not lose money and grow your business?
Yeah, and it's a lot. It's a lot of, it's a lot less things getting done. There's very few deals that are just actually getting through on the Amazon centric, aggregator space in general. But as Jason already alluded, there's a lot more activity outside of that very myopic and one little sliver of the consumer product space. And so, yeah, but again, even in that world, I mean, while middle market valuations are still pretty rich, you're still seeing lower middle market valuations, come in. And even there, you've got to have you have to have a great company. You just do. And we can define all of that as we go through this podcast together, but
Perfect.
you really do. You have to have a really good company.
We're going to get to that. It's interesting. The M&A space, we had this big, quick boom followed by a quick bust. Jason, before we started the call, you were telling me about Thrasio. What was the news that you were sharing with me before the call?
Yeah, today, I mean, it's been rumored for a long time that they were getting ready to file bankruptcy, and it sounds like they did officially file today. So they released a press release actually at like 1 a.m. in the morning last night.
Good time to do it.
And yeah, when everyone's asleep, that's when you want to do it. And so what was long rumored has now become official. So now I would say what's interesting about it is it's a Chapter 11, so they're going to try to emerge. They say they've gotten like heavy concessions from the lenders. They're gonna take some pretty big haircuts. They say that some of the lenders are willing to put in a little more capital, so they're going to try to come out of it. We'll see. I'm pretty skeptical. I mean, I think the quality of what they bought is overall pretty poor. So I think it's going to struggle for sure, given the capital structure. But I don't know all the final details yet of like what the restructured company capital structure is going to look like. So more to come there. I mean. And the filings are available publicly. So if anybody wants to do like a deep dive into the situation, have at it. Good times.
Yeah, get your bankruptcy legal language thesaurus ready to do it. It's like a yawner. If you have trouble falling asleep tonight, go look it up and read it. Those are hard to read. It's easy for you guys. For me, it's like, can't they just use real English? But and the Unibrands, I mean, the Unibrands press release was a bright spot. Would you guys agree? I mean, they did a deal. They did a raise.
I don't know. Yeah.
Don't know. Okay.
I mean,
fair enough.
Yeah, I would say I'm just going to give my own opinion. I think it's a question mark of, yes, the fact that they got a raise, and went to Series B, that's very good. That shows that there's a lot of great green shoots going on within that particular, what do they call them? Digital brand house now, or digital house of brands, I think is what they're trying to call them. They're trying to rebrand.
That's the entire sector rebrand, that no one calls themselves an aggregator anymore.
Yeah, because that's a stigma now, and it's definitely a stigma with the Thrasio, bankruptcy. But I would say the acquisition is very mysterious. So I don't know if it's a good thing or if they just did. Maybe they bought several brands that were just really good brands. That's one path. Yeah. Maybe they bought good, as we've been talking about, good company, bad balance sheet, right? That's okay. Maybe it's a complete distressed asset turnaround. They bought inventory and, they bought some trademarks, and they believe that, hey, because of the Series B, hey, we've got a team that is highly capable, and we've got some real, kind of thunder in our feet thanks to this new round of funding, and we can make these brands, much better than what they were wherever they were. I think that's just what it is. It was a very like lofty press release, but no, I mean, the fact that they got funding is very good.
Yeah, and something similar, we like Society Brands is a company that is kind of in that world too. They announced a couple more acquisitions this week as well. One of the themes though that's kind of emerging here is this idea of bargain hunting. I think there's a lot of bargain hunting going on right now, where we'll call it the vehicles, in this case we'll use the word aggregator for this discussion. The aggregators that are funded and have actually, they're doing, I'd say, well, a lot of them are looking for those, kind of bargain opportunities. There's some of that going on here as well. As Chris mentioned, that good business, bad balance sheet scenario. that's not going to be long lived, because usually those kinds of things last for a fairly short period, and then they're back to wanting to just buy quality. But right now, there's definitely some of that going on.
Let's back up a second, guys. GW Partners. When I spoke to you guys last, I don't know how long ago it was, but ahead of our prep call for the podcast episode, you were telling me some things you guys are doing, and my experience is pretty different and unique in the space. What is GW Partners? How do you guys differentiate yourselves, in a crowded market? And what are you guys all about?
High level, we sell companies. That's what we do. However,
that's not very
now
sexy.
Layering in,
you guys are much sexier than that. Come on, man.
I know. So now let's layer in the marketing, right?
Let's do it.
I mean, our whole mantra and the way that we do differentiate, we are absolutely a boutique now. It's just myself and Jason. We are very, very, I hate to say we are selective. In general, we are selective just because of bandwidth, but we're working with companies now a lot earlier than just straight up volume play. Let's go to market. Let's sell the business. We're getting involved, call it anywhere between, at the low side, 12 months to 24 months earlier than when it's time for them to start marketing the company and go through a process. We've got a lot of things on our website, and then we name a lot of different titles, but it's the truth.
CFO, COO, CMO, board members, advisors, M&A team, growth consultants. I mean, that's great. That's a lot. That's a lot of value that you guys are bringing. How do you manage all that?
The overall spirit and purpose is just to say, we want to get involved in every function so we can influence a much more optimized sale of the business. We have the answers to the test. We know what private equity is looking for. We know what we know what the capital world is looking for, who wants to buy your business. We're no longer working with just Amazon-centric brands. We're working with consumer product brands. That is either omni-channel, D2C, that could be retail only, who wants to now kind of rotate into being more direct to consumer focused. So, we're more diverse, but we are only consumer products. So we're not selling agencies, SaaS. We're not doing anything but consumer products because we're really good at it. Honestly, we know consumer products really well, and we know our lane. And so we're specialists within that particular, sector, I guess you could say. So yeah, that's what we're up to now. And I mean, the way we differentiate is, honestly, just talk to us. Like, we will speak your language. We will speak the language of an operator, and we will actually empathize and understand what it is you're going through. And when you say things like, I'm getting lots of pressure on my CAC, we completely understand what that means. And we also understand different activities that can help relieve that pressure and turn you into a much more profitable, LTV heavier company, right? So that's where we really differentiate. I mean, if you speak to other advisors that are in the space who maybe there's very similar, we focus on consumer products, you tend to not get as much depth in the conversation around really understanding, I understand your business, but not only that, we sell companies. So I understand your business, but I also know how to sell the business.
As someone who had a products company and then now has a service company, there's a big difference. That little small thing of being able to buy, manage, and turn inventory is kind of a big deal.
Yeah.
And it's good to have folks who understand what that looks like on the balance sheet, on the cash flow statement, and on the P&L. I know everyone's so P&L centric, but those other two sheets are kind of important when you're moving a lot of inventory. Yeah. So I think it's wise of you guys to focus on this product space, and of the folks that I know out there, you guys are the best. So Jason, how'd you guys get started, and how'd you get mixed up in this business?
I had a career in institutional investment banking with Bank of America and a big hedge fund in Miami. And then I became an entrepreneur. Yeah.
Isn't BofA in Charlotte in a big way?
It is, but ironically enough, I grew up in North Carolina and wanted to leave, for a different experience. So I worked for BofA in Chicago.
Oh, wow.
So yes, so I do have, some Chicago history, and then made my way to Miami, lived there for a long time, and ran capital markets for a big hedge fund. But I decided to become an entrepreneur. I sold some companies of my own, and then decided, what, I'd like to be an advisor to founders, kind of marry up that whole, combination of, I know how to run small companies, I know how to sell small companies, I also know how to sell big companies. And I know what it's like to be a founder, right? I know what it's like to be an operator, an entrepreneur. And that's kind of originally how we started. And then, felt like the digital consumer space was just an exciting space to be. So now 7 years ago is when we decided to specialize here. And, I think what we're doing now, I mean, what we really love about it is being able to just partner with these founders much earlier in the journey and kind of have a hand in the development of the company and the evolution of the company, which not only I think is incredibly valuable, but it's also incredibly necessary. We talked at the beginning of this, about how the market has changed. Well, if you have a goal of having a very, I'd say optimized type sale, at some point in the future, the amount of strategic planning and execution that has to, go into that is far greater than it was 2 years ago, 3 years ago, 5 years ago.
Yeah.
And that's where we also, really enjoy kind of helping founders say, look, there's a lot more you're going to have to do to get to the promised land. We're here to help you do that and to fill in those gaps. That's why I always use a cheesy, I steal the Bruce Lee quote of be water, right? Is what we try to do is we try to be water and try to flow into the gaps in the company and basically fill those gaps. So if you have a founder that's an amazing marketer but terrible at finance, we're going to spend a lot of time on finance, right? If you have a finance wonk like me running the company, we're going to be working on marketing, right? Because you already know your numbers really well, right? And so we're trying to flow into those areas, which a lot of founders don't have that kind of strategic support.
And Chris, we've known each other for a long time, and Amazon businesses have changed. I'm going through in my head our list of clients. I don't know that any of them are Amazon only anymore.
No.
What in your mind have you seen change in the last 7 years since you guys have been working in that space?
I kind of got involved in Amazon I'll succinctly go through I've got involved in Amazon when a random bookseller showed up to my booth at a trade show and wanted to sell my product in 2004. And, kind of saw the evolution of what Amazon was then through really starting their own marketplace and what that became. And, I've always worked in consumer products. I've always seen Amazon as a channel. That's it. It's a one channel. That's all it is. It's a sales channel. It's not the channel. It's just a sales channel. And so I think what you're starting to see is you had this run up of a lot of just product being sold through Amazon. And now what you're seeing is just those who only sold through Amazon realized it is stealing our friend Adam Runquist's kind of analogy. It's a melting ice cube. I mean, you have, if you want to build something long-term and sustainable, sure, you've got some examples of like Hero Cosmetics and Zesty Paws and et cetera, but they were only valuable assets when they went away from Amazon, rotated away, and started really building out their brand and brand equity as a true consumer products brand. And what does that mean? It means I'm trying to reach the consumer in every possible way that I can outside of just Amazon. And again, I'm rotating my mentality and I'm rotating my strategy to become a more consumer products focused company. There still is plenty of commerce being done in Walmart and Target and specialty stores like Ulta and Sephora and Ace Hardware, Lowe's, Home Depot. I could keep going. Not only that, but the race towards just trying to become better at direct to consumer. All around, I think brands realize if I want to have something long-term, sustainable, and truly equitable, I need to actually do more than just focus on this channel. That's the evolution I've seen. And I think a lot of the commodity guys are just getting squeezed. I mean, you just cannot sustain a profitable unless you just are consistently surfing that arbitrage wave. And I think it's just too crowded. And I just don't think Amazon's also just not making it easy anymore. Although 50% are Chinese sellers, and I want to hear what you think about that. I'm really curious to hear what you think about that. It seems like, and it almost like they're talking out of both sides of their mouth, 50% are Chinese sellers, but Amazon wants you to focus on being a better brand. I mean,
they do.
They are trying to be more brand centric and brand heavy. So I'm actually going to throw it back on you, man, as an Amazon expert. Like,
Thanks,
what do you think about this whole 50%? Yeah. What do you think about this whole Chinese seller stuff? And, what's your thought process on all of that?
I started selling in 2003. My first listings looked like a factory spec sheet. They were garbage.
Yeah.
I mean,
Yeah,
I
the
did
PDP was
nothing.
terrible.
I did nothing. I did no advertising.
It's like an RSS feed, man. That's what it was.
Oh, it was terrible. It was terrible. Like you had to guess what you were going to get at your doorstep when it shipped. And in spite of that, we did 100,000 in the first year, 1 million the next year, 2 million the next year, 4 million after that. We were literally doubling because they had the customer, right? There are things that I like about Amazon, the ability to be able to launch a product on a very big marketplace with a low cost of acquisition compared to a DTC
Yes.
website, to be able to
100%.
collect feedback in a lot of different ways, questions and answers, feedback, reviews, ratings, and to be able to do something about that with that, and reasons for returns. It's just a great platform to launch a product and get customer shopper feedback and help that product evolve to become a better product that could someday do, as you described, Chris, be sold in another big box store or another e-commerce platform. And it just seems like every quarter they're launching more tools to allow you to do that. I mean, you can have a beautiful brand presence now on Amazon. A+ details, storefront. You could do brand tailored promotions. You could do posts. You could
Prime
do
Video,
social media type posts.
Prime Video advertising.
Prime Video.
I mean, it's all
Don't get me started. CTV. Like in the old days, you put up a crappy listing and you'd get lucky and it would work. And then now, for the first time over the last 2 years, really this year in a big way, you can actually develop demand, brand awareness, mind share with Amazon's tools. So for that, in that regard, I love it. I love it. I think I think the next $1 billion brands are being born on Amazon today. They're not going to end on Amazon only as a $1 billion brand, but they're going to have to expand, and they got to come talk to you guys on where to go next and how to make that work. The China thing is troubling to me. It's troubling for a lot of reasons. I don't like these apps coming over. I don't like Temu. I don't like Shein. I don't like these apps coming over into the United States, because I'll tell you why. When I go to China, I can't access my Gmail. I can't go to my Instagram feed. It's a total Chinese firewall. And so fair's fair, right? And so I know that Amazon likes to keep low prices, and nurturing that China factory base is fine. If they have to match the same rules and regulations that a US seller does, bring it on. Bring on the competition, right? But I don't like that they don't. They really don't, in a lot of different ways. That's the time for another episode. I'll come on your guys' podcast. We'll talk about that later, right? I'll come on your podcast and we'll talk more about this, Chris.
That's right. It's just, you're right though, and we'll move on from this, but it's just, there is a consensus that it's not sitting well with a lot of people. However, Amazon's still making plenty of money, so they don't care.
They don't care. And I got to tell you, like 5 years ago, you could tell when there was a Chinese seller. We used to make jokes about their listings because they were hilarious when you read them in English. It was Chinglish. You can't you can't differentiate now. They have leveled up and they are playing really hardball. They're doing well. They're building great brands. So, I mean, those Chinese sellers, more power to them, but it should be fair. It should be fair over here. It should be fair over there. And our politicians and regulators need to get off their ass and do something about that. But that's a topic for another time, Chris.
On our podcast. You're coming on
your
podcast.
podcast.
Absolutely.
I'm in.
That's all right.
I just invited myself. We've established that there are some deals happening. It ain't the gold rush of 2021, but deals are happening. Help our listeners and viewers understand, what are buyers looking for? What's an aggregator look for? What are the PEs look for? Is it the same? Is it different? Educate our group on how they need to be thinking when they think about a potential future acquisition target to acquire their business.
Number one is strong customer retention. Customer retention and all the metrics around customer retention are, I'd say, front and center for any consumer products, kind of especially digital consumer products brand that wants to think about selling currently. So now that can look a little different, right? From a beauty business, say, compared to a food business, compared to an apparel business.
Or a pool table business.
I would say,
isn't going to have a repeat order on that pool table for 10 years, right?
Right. Exactly. So what is, I'd say, in favor, though, in the current market are businesses that can demonstrate a high level of retention, and that retention ultimately leads to greater profitability over time.
What do those metrics look like? What are the KPIs there?
Yeah, so I think the most basic metric is, what do my LTV curves look like and how are they shifting? If my 12-month LTV 9 months ago for, like, say, my cohorts that were 12 months before that, is $100, and what's my 12-month LTV cohort right now? Is it $110? Is it $95? Is it $115? Like, are you seeing movement, right, in those curves so that you're demonstrating higher, overall lifetime value at the same point in history for a cohort? That's kind of one of the main places that buyers are going to park, and they're going to park there for a while, right? And look, there are obviously plenty of businesses that are one and done businesses that are very profitable. So it's the kind of thing where you're probably going to buy it once, and if you buy it again, it's probably going to be 5 or 10 years later, right? And it's not that those businesses are necessarily unsellable or that they are, not good businesses, but businesses like that right now are not in favor. So, they are not very popular, let's say, among most acquirers. Now,
That makes sense. That CAC is high. Yeah, that CAC is high for that big one-time purchase, right? And you gotta make money on that first order. You can't make it up on repeat orders where you maybe don't have to pay for the ad.
the backdrop is we're seeing a lot of inflation in customer acquisition costs across like a lot of businesses. So it's like that's kind of a general theme. Like, I mean, there's a general thing happening in the market that across pretty much most consumer products businesses, direct to consumer, e-com, you're seeing an inflation in CAC. There are exceptions for sure, but as a general rule, that's kind of a trend right now. So what a buyer is looking at is like, okay, if I have to make all my money on the one purchase in a world where CAC is going up for everybody, how do I model that out in the future? Where's this CAC curve going to go, right? And it just creates, you got to remember, what are buyers really trying to do at the end of the day? They're trying to assess risk, right? And they're trying to model risk. And the harder it is to model risk and the more potential outcomes, that exist, and if you start to get wide in that range of outcomes and a lot of them turn out pretty bad, it just makes it, when you're not in that gold rush environment where people just kind of are buying whatever they can get their hands on and ignoring all the fundamentals. That's not happening anymore. Fundamentals are really key right now. That's what makes it less attractive for buyers, right? So if I have a high repeat order, consumable kind of business, I mean, dude, that's why you see, like I said at the beginning, what are the sectors that are most active right now? Food and beverage and beauty.
Yeah.
Right. It's a very repeat order, consumable type business. So if you own a business that's more of that one purchase type business, it doesn't mean, oh, you're doomed. It just means what you have to start thinking about is, how do I start expanding my business around what might be an anchor product? And really, instead of focusing time elsewhere where I might not be as rewarded for it in an acquisition, I need to spend my time figuring out how I can build things around this that might result in future business from these customers that I'm acquiring. It's like, so a lot of times it comes down to, well, you have a lot of choices with where to put your time and energy and money. A lot of times it's making the right choices with those resources that are going to have value in an acquisition, because and knowing what those are, right? So this is a good example of that.
I love that story. Chris, I joked with my brothers when I exited my company, and we sold big stuff: air hockey tables, foosball tables, ping pong tables, billiard tables. And we did it for 17 years, and we were a top 200 seller. And I told my brothers at exit, I said, damn it, if we had just built a deodorant company, we'd be billionaires right now. Right? Why? Because it's a consumable, and because that cost of acquisition goes down on every repeat order from the same customer. Jason, I got to tell you, and Chris, this is going to be the same for the next 100 years, right? That's why food and beverages, that's why alcohol is so good. That's why these consumable types businesses are just more valuable, because it helps to soften the blow of that initial customer purchase. Right, Chris?
Yep. Yeah. Absolutely. 100%. No, I mean, that is why they're so, and especially if you can be profitable first sale and you've also got strong LTV, I mean, you are in really good shape, as long as you just haven't blown up your OPEX and acted like a moron with your OPEX, then yes, absolutely. That's a very valuable company. No question.
So guys, I want to ask you about what is an ideal client for you? Where's your guys' wheelhouse? What size company? Obviously, you want to talk to companies that are selling right now, Jason and Chris. You guys got, the consumables, the food, and the alcohol. They should call your number right now. But what does that ideal client look like?
So ideal client for us, revenue is going to start somewhere around, 5 to 7 million. And, again, they've got an exit in mind as a long-term goal, but, is going to be much higher than what they would achieve at 5 to 7 million, because we want to get involved. We definitely want to get them at least over 10 million of revenue, because that's where they're going to actually have a chance to get in front of, private equity, family offices, corporate strategic desks, et cetera, and just be a much more valuable asset. We've talked consumer products is our gig. Yes, we're very agnostic when it comes to category. However, we are very active in baby products and also in beauty as well. But consumer electronics is something we tend to shy away from, but we'll take on pretty much any other category. So
that's awesome. So 5 to 7, you guys come in 24 months early, maybe 12 months early, and you want to see a growth rate there. And I've heard bankers tell me in the past the rule of 40. Which says you could have 40% growth and maybe no EBITDA, or you could have 20% growth and 20% EBITDA. Is that a thing in our space, guys, in the product sales space, or is that old and outdated?
That's kind of old. I would say in the current environment, profitability is absolutely the main focus. So, and that's profitability up and down the P&L. So buyers looking at what's my gross margins, what are my contribution margins, what are my net margins? And there are absolutely benchmarks that you need to be hitting in order to even be really for it to be worth going out. We went through that period where revenue growth was really rewarded and profitability was kind of like, not as focused on. We're out of that period
good
now.
Old days.
Yeah, we're out of that world. Now it's about profitability. Now, granted, of course, growth, definitely want to be showing growth. But if you told me right now, I can show 40% growth, 20% growth, 30% growth, but no profitability or very little, or you're not reaching benchmark, it doesn't matter. My advice to almost any company right now thinking about exiting in the next 2 years with a of the kind we're talking about is we need to focus on how do we get to our profitability goals first, and then we'll focus on how to drive growth while maintaining that profitability.
I love that. And there's all these. Anyone who's a fan or reads a lot of business articles, what a lot of small sellers don't understand is you've got to have that cash flow in order to grow that business. What they don't realize when they read the headlines of companies that have been out there for 10 years and never made any money is they raised hundreds of millions of dollars that they're burning. And if you don't have that big pile of cash on your balance sheet to burn towards growth, you've got to be profitable. Not only will you not be able to sell if you're not, you're going to die. And so I think that's a great message and story. How often do potential clients come to you guys and say, I'm ready to sell? How often are you looking at the P&L and the financials and going, well, buddy, we're going to have to do something about this profitability first?
The majority. Yeah, the majority of the time. Yeah.
Got it. What is like the top 1, 2, or 3 steps that you find yourselves recommending to brands after that first meeting that they can take to start towards the path to greater profitability?
Well, first of all, we typically talk benchmarks. We're saying, okay, well, where do I need to be in order to be seen as a top performer in my peer group? Right? Usually we end up talking about, okay, well, what are we even shooting at and why? That's usually where we start, right? And that kind of sets the tone for how far are we from the mark, right? And then once we know how far we are from the mark, we talk about what needs to be done. Like a perfect example might be, well, look, your gross margins are perfectly fine. Your contribution margins suck, and it's because you've got your ad spend is just super inefficient. Right. And we have to look at that, and say, all right, well, we have to get that in line. You have the gross margin in order to do that. And your peers with similar gross margins are able to get better contribution margins because they're more efficient with their ad spend. We have to make sure you get there. Now that's where you need to focus. Or we look at the OpEx and go, you're a $8 million company, but you have the operating infrastructure of a $50 million company. Like that's bad. Like we need to right size that.
Yeah.
And then that's going to free up cash flow to use, for growth in the right places, because you know what, there's no reward for extra bodies at the table. It's got to be efficient, right? It's got to be efficient. So those are usually like on the financial side. And then on the non-financial side, a lot of times we're talking about brand. We're talking about, who is your customer, and do you know your customer? I mean, part of a lot of like our initial assessment is around how well does a founder or company really know its customer? Because that's another prerequisite right now for wanting to get to like a good place from a growth and acquisition standpoint, is you have to really know your customer. And if you don't, we got to get to know your customer better. Like we need to learn more about your customer so we can then make the right decisions around product development, marketing, et cetera, channels. Like, hey, my customer loves Amazon. Great. Let's make sure we're focusing on Amazon. But also, what else do they love? Do they love Walmart? Do they love Target? Where are they? Are they heavy Meta users? Are they heavy TikTok users? It's like really getting intimate with that, understanding that customer, and us figuring out, okay, seems like you don't know your customer that well. We gotta work on that. Like that's good examples.
Chris, of those 10 out of 10 customers who come to you and you go, guys, we got to work on profitability. The game's changed. I love that you've got 120% growth, but that 20% loss is really kind of not going to help you right now. How do some of those conversations go? Give me an example of one that's gone well, and give me an example of one where they just don't get it.
Yeah, gosh, an example of where things have gone right and where things have gone wrong. I mean, I'd say where things have gone right, they trust our advice and they want to actually work with us, and they want us to come in and roll up our sleeves and help them, right size the ship and really start steering everything towards the goals that are outlined for their company. And that's kind of our core product. That's what we love doing day in, day out. Where it's gone wrong, they just simply are like, yep, my friends told me otherwise. I don't believe you. And we either never hear from them again.
I saw TikTok differently. Yeah. Okay.
Basically. So, or, my mastermind group said this, or my friend who exited for 10 times revenue says you're an idiot. And I'm like, that's totally fine. You guys can say whatever you want. And then sometimes we hear back from them and they just never talk about it. And most of the time we never hear from them again. And we never see them pop up in any press releases that they actually sold their business. So yeah.
Right.
We're pretty spot on. I mean, again, unless you've got the cure to like the next greatest thing and you're losing money, the likelihood of you getting a deal done is zero. Let's just be honest. It's just zero.
Jason, those benchmarks that you referred to, do you guys look at benchmark? Is it sort of category specific, channel specific, or all the above when you evaluate a business and identify their current state?
Yeah, I think it's all the above. So whether you're talking about, hey, what's my profitability on a SKU level, on a channel level, even when you layer in, okay, well, what about my acquisition channel? Like not just sales channel, but acquisition channel. Like, okay, well, how efficient is my email marketing, which typically isn't an acquisition channel, but how efficient is my Google ad marketing? What about my organic traffic and my conversion? How am I converting? And not only just how am I converting overall on my site, but like how am I converting with different types of traffic, right? So it sounds really complicated, and it is really complicated, but here's, I think the overriding message is, if you think you can fake it, you can't. Like at the end of the day, buyers are now going to scrutinize everything, and they're going to determine if this is a really healthy company, or if below the surface what appears to be good has like rot somewhere and or has a tumor somewhere that they're going to find it. And so you just can't fake being really good everywhere. And that's where you're trying to be really good everywhere, and that's kind of what it takes right now, is to be really good everywhere.
I get it. Is it going to stay that way? Are we going to stay in this rational space that we've landed in after the post-boom era? No.
We never stay anywhere forever. That's how markets go.
It's all cyclical.
This is great. Some irrationality will introduce itself in the market at some point in the near future. Oh, that's good news.
I would argue that last year, and even so far, maybe I think it's actually it's overcorrected. People know that it's overcorrected. So I'll give you a good example. This is going to be very typical of a Tuesday for us. I was on the phone with some guys who actually are from the oil. They made all their money in oil and gas, but they just bought a small food business, direct-to-consumer food business. And I was on the phone. They're new to the consumer game, but they've got, tens of millions of dollars, and they want to put it to work in consumer because they know that things are being undervalued right now.
Okay.
And so it's like, and when you start, it's funny because when you're active in the market, like us, and we're having these kinds of discussions all the time with different types of capital and buyers, those are the kind of things where the tea leaves are starting to kind of show themselves. We're like, okay, you've gone to overcorrection when the oil and gas guys have heard that consumers cheap right now. Right? So, okay, cool. We've officially overcorrected. We'll probably be coming back a little more to the middle sometime soon.
It's true. That's so true.
Chris and Jason, tell us about this podcast and how can folks reach out to you to have a conversation so that they can tell you they're profitable enough,
Podcast is called The Quiet Part Out Loud, and we will be talking about things that people don't talk about. For instance, we did a podcast today with a subject matter expert on email marketing, and we also did one the other day with somebody in product development, and it's really unearthing the things that no one's really talking about. Like, for instance, when it comes to product development, you should be thinking about the consumer first. Well, what does that actually mean? Well, it means research. Well, what does research mean? Well, there's a lot to research, but guess what? It's also within reach. So it's just going, and there's actually most of our podcasts are just Jason and I for 15, 20 minutes talking about some topic. Like we have one topic that we're going to launch called Your Agency Sucks. Is that your fault or their fault?
Oh, yes, please. I'm going to download that one immediately following the podcast. Thank you, Chris. Thank you, Jason. You're doing God's work on this podcast.
We are. Well, and not to get into it here, but the reality is, like, who's running the strategy, the brand owner or the agency? And it should be the brand owner, 100%. There you go. I already gave the answer to the test.
There you go. Unless the brand owner doesn't know how to do strategy, then they should listen to the strategists on the agency side for recommendations.
Well, then they should just sell it to you guys and go take a hike in Tahiti. That's what they should do.
Chris, I always find our conversations entertaining as hell. I think the podcast will be great. I'm going to definitely download it. Thank you for coming on the show, guys, and sharing your insights. I think the true money moment, Jason, is when you said, oh yeah, the irrationality is going to come back. And it's already maybe starting to see some signs that everyone knows there's been an overcorrection. That is good news, sellers and brand product owners. Hang in there, work on your profitability, work on maximizing your long-term value of your customers, build that customer list, lower that cost of acquisition long-term, and give these guys a call so that you can get that big fat check that'll change your family wealth scenario overnight.
Absolutely.
Thank you guys. I appreciate it.
Thank you.
If you're ready to start growing and protecting your brand on Amazon with a team of experienced Amazon operators, you can visit us at day2podcast.com. That's day2podcast.com. And lastly, if you know anyone else who would benefit from great content like you just heard from Jason and Chris from this podcast, please share it with them. Thanks for listening and happy selling.